This is the second part of the presentation for Chapter 15, Stockholders, Equity. In this learning objective, we will explain the accounting and reporting issues related to dividends. Most companies do not pay dividends in amounts that are available to be distributed, and there are various reasons for this. For example, many debt covenants limit the dividends that companies can distribute so that there is sufficient cash to meet interest and principal payments. State incorporation laws may restrict dividends for treasury stock held. Companies may retain earnings so that they can internally finance plans for growth and expansion. Companies also prefer to smooth out dividend payments to prevent large fluctuations, especially in a downward direction. Also, if management anticipates that the company may experience losses, they will retain earnings to prevent having negative retained earnings. It is short-sighted for companies to pay dividends that can cause them to experience liquidity problems. Therefore, companies should avoid paying dividends unless both their present and future financial position warrant the distribution. However, the SEC encourages companies to disclose their dividend policy in their annual report, especially if they have sufficient earnings but are not paying dividends, or if they do not expect to pay dividends in the future. They also prefer that companies which consistently pay dividends forecast whether they expect to continue paying them in the future. There are different types of dividends as shown on this slide. Cash dividends are ones that are most familiar. However, companies can issue property dividends, or dividends in kind as they are called. In this case, a company distributes non-cash assets such as shares of stock that they hold in other companies. Sometimes companies will issue liquidating dividends that return a portion of the shareholders' original investment to them. All dividends except stock dividends reduce total stockholders' equity. As we discussed in the first presentation, the Board of Directors vote on the declaration of cash dividends, which then become a current liability of the corporation until issued. Cash dividends are not declared or paid on treasury stock because the company would not pay itself cash. However, stock dividends are declared and distributed on treasury stock. The three dates that are involved in dividends are the date of declaration, when the Board of Directors authorizes the dividend, the date of record, which is the date that the list of stockholders is compiled for payment of dividends, and the date of payment when the dividends are distributed to the stockholders of record. To illustrate recording cash dividends, we will consider David Freight Corporation that declared on June 10th a cash dividend of $900,000 equal to 50 cents a share on its 1.8 million outstanding shares payable July 16th to all shareholders of record as of June 24th. On June 10th, David Freight Corporation would debit retained earnings for $900,000 and credit dividends payable for the same amount. There is no entry on the date of record, June 24th, but the company or the company's transfer agent or registrar would compile a list of the stockholders who own shares on this date. On July 16, the dividend payments would be distributed to the shareholders of record, and the company would debit dividends payable for $900,000 and credit cash for the same amount. As we discussed earlier, corporations may issue property dividends that are payable in assets other than cash. At the date of declaration of the dividends, the company will restate the value of the property to be distributed to fair value and recognize any gain or loss. To illustrate a property dividend, we will consider Hopkins Inc. that transferred equity investments with a cost of $1,250,000 to stockholders by declaring a property dividend on December 28, 2019 to stockholders of record on January 15, 2020 to be distributed on January 30, 2020. At the date of declaration, Hopkins would restate the equity investments to their fair value of $2 million by debiting equity investments for $750,000 and crediting unrealized holding gain or loss income for the same amount. At the same time, Hopkins would debit retained earnings for $2 million and credit property dividends payable for the same amount. On January 30th, Hopkins would distribute the shares to the stockholders and debit property dividends payable and credit equity investments for $2 million. Liquidating dividends are any dividends distributed that are not based on earnings but are paid out of corporate paid-in capital. It is important that the company advise the stockholders of the portion of the dividend that is a return of their original investment. Liquidating dividends are commonly issued by companies in the extractive industries. To illustrate one, we will consider Harani Mines, Inc. that issued a dividend of $1,200,000 to its shareholders. Harani indicated in the announcement of the dividend that $900,000 was from income and the remainder was a return of capital. At the date of declaration, Harani would debit retained earnings for $900,000, debit paid-in capital in excess of par common for $300,000, and credit dividends payable for $1,200,000. At the date of payment, Harani would debit dividends payable for $1,200,000 and credit cash for the same amount. Companies may also issue stock dividends to their shareholders. Management may wish to capitalize permanently a portion of their retained earnings by issuing shares of stock to the current shareholders on a pro rata basis without receiving any consideration. It is important to note that when a company issues a stock dividend, stockholders' equity is not decreased, but rather the components of stockholders' equity are modified depending on the percentage of stock that is distributed. In a small stock dividend, retained earnings will be debited for the market value of the shares distributed. The reasoning for this treatment for small stock dividends is that smaller stock distributions do not substantially affect the value of the stock in the market. To demonstrate the recording of a small stock dividend, we will look at Vine Corporation that has outstanding 1,000 shares of $100 par value common stock and retained earnings of $50,000. If Vine issues a 10% stock dividend, it will issue 100 additional shares to the current stockholders. If the fair value of the stock at the time of the dividend is $130 per share, then the dividend would be recorded by debiting retained earnings for the market value of the 100 shares, $13,000, crediting common stock dividend distributable for the par value, $10,000, and crediting paid-in capital in excess of par for the remaining $3,000. At the date of distribution, Vine Corporation would debit common stock dividend distributable for $10,000 and credit common stock for the same amount, and the shares would be distributed to the common stockholders. Some companies wish to keep the market price of their stock at a lower price in order to encourage wider ownership of the shares. If the market price of the stock increases too much, the company may declare a stock split to reduce the market value of the shares. There is no entry when a stock split is declared. The company merely decreases the par value and increases the number of shares. This slide illustrates the effects of a 2-for-1 stock split. If a company had 1,000 shares of $100 par value common stock prior to the split, they would have 2,000 shares of $50 par value common stock after the split. Each of the common shareholders would receive one additional share of stock for each share that they owned prior to the split. This treatment reflects the reaction of the market to a stock split, which will result in the market value of the shares of stock dropping by half, for example, when a 2-for-1 stock split is announced. Occasionally, companies will issue a reverse stock split to increase the market price of the shares. In this case, the shareholders will relinquish a number of their current shares, and the par value on the remaining shares as well as the market value will increase. In between a small stock dividend and a stock split are large stock dividends. These are stock dividends that are greater than 20 to 25% of the number of shares previously outstanding. Large stock dividends have the same general effect as a stock split of reducing the market price of the shares. However, they are recorded differently by the company. The par value of the shares issued is transferred from retained earnings to capital stock. To illustrate the recording of a stock dividend, we will look at Rockland Steel, Inc. that declared a 30% stock dividend of 300,000 shares on November 20th, payable on December 29th to stockholders of record on December 12th. At the date of declaration, Rockland Steel had 1 million shares of $10 par value common stock outstanding, and the stock had a fair value of $200 per share. To record the stock dividend, Rockland would debit retained earnings for the par value of $3 million and credit common stock dividend distributable for the same amount. On the date of distribution, Rockland would debit common stock dividend distributable and credit common stock for $3 million. In this learning objective, we will discuss how to present and analyze stockholders' equity. This slide shows the stockholders' equity section of the balance sheet for Frost Company. The statement presents legal capital first, including both the preferred par and common stock stated values, as well as a common stock dividend distributable of 20,000 shares. The preferred stock is always shown first because preferred stockholders have preference in liquidation before the common stockholders. The preferred stock is cumulative, and the total par is shown, as well as the par value per share, the number of shares authorized, issued, and outstanding. Next, the total stated value is shown for the common stock, and the stated value per share and number of shares authorized and issued. The total capital stock equals the par and stated values of the outstanding preferred and common shares and the common stock dividend distributable shares. Next, the additional paid-in capital amounts for the preferred and common shares is added to the total capital stock to arrive at total paid-in capital. The retained earnings and paid-in capital are summed, and the cost of treasury stock and accumulated other comprehensive loss subtracted to equal total stockholders' equity. Any restrictions on retained earnings must be disclosed, and this is usually done in the notes to the financial statements. Restrictions on distributions of retained earnings can come from a variety of sources, including debt covenants that restrict distributions in order to maintain certain working capital requirements, or state laws that restrict retained earnings for treasury stock. An example of note disclosure on retained earnings restrictions by Alberto Culver Company is shown as an illustration. This slide shows an alternative method of presenting stockholders' equity in a columnar format that reconciles the ending balances from the prior period with the current period ending balances in one statement. This reconciliation is necessary for the shareholders to identify the transactions that have affected the stockholders' equity accounts during the current financial statement reporting period. Additional information regarding changes in stockholders' equity is provided in the notes to the financial statements. 3 of the common ratios used to analyze stockholders' equity are shown on this slide. These 3 ratios are primarily used to gauge the profitability but also the long-term solvency of the company. We will discuss these 3 ratios in more detail in the following slides. The first ratio, rate of return on common stockholders' equity, is illustrated for Marshalls, Inc. It is important to note that these ratios are intended to provide information for the common stockholders. Therefore, the preferred dividends that have been paid of $54,000 are subtracted from the net income of $360,000 before dividing by the average common stockholders' equity of $2,550,000. The rate of return for Marshalls is 12%. To determine whether this is an acceptable rate of return, analysts and other users of the financial statements would compare this rate to prior year's return on common stockholders' equity and with other companies that are in the same line of business. The payout ratio is shown next. This ratio calculates the percentage of net income that is distributed to the common shareholders as cash dividends. The illustration states that there is no preferred stock outstanding. If there was preferred stock and it received a dividend, then the denominator would include only net income available for distribution to the common shareholders. The last ratio illustrated is book value per share. The numerator of this ratio is common stockholders' equity, and the denominator is the outstanding common shares. The calculation of this ratio can become quite complex if there is preferred stock. Examples of computations of book value per share that includes both cumulative and participating preferred shares will be illustrated in detail in future slides for the appendix to the chapter. The last learning objective for the chapter covers the appendix, which includes a calculation of different types of preferred stock dividends and their effect on the calculation of book value per share. To illustrate preferred dividend preferences, we will use the example of Mason Company, which chose to distribute $50,000 in cash dividends to its preferred and common shareholders. If a dividend is distributed, the preferred stockholders must receive their dividend before any distribution is made to the common shareholders. In the first example, the preferred stock is non-cumulative and non-participating. Therefore, only the current preferred dividend of 6% of the par value of the preferred stock of $100,000 would be due. The distribution of the dividend would be $6,000 to the preferred shareholders, and the remainder $44,000 would go to the common shareholders. In the second example, the preferred stock is cumulative and non-participating. Mason has not declared the preferred dividend for the past 2 years. As we mentioned in the first presentation, when preferred stock is cumulative, the dividend in arrears, $12,000, would have to be paid, as well as the current preferred dividend of $6,000 before the common stockholders can receive a dividend. Therefore, the total dividend to the preferred shareholders would be $18,000, and the remainder of the dividend, $32,000, would be distributed to the common stockholders. In the third example, the preferred stock is non-cumulative but is fully participating, which means that the preferred stock participates ratably with the common stock in any dividend distribution. As the illustration shows, both the preferred and common stock shareholders would receive 6% of the par value of the shares, since the preferred dividend is 6%. The preferred would receive $6,000 and the common $24,000 for a total of $30,000. The total dividend declared was $50,000. Therefore, the remaining dividend of $20,000 would be allocated between the preferred and common shares based on their relative par values. The $20,000 is divided by the total par value of the shares, $500,000, to determine the rate of 4%. Then 4% of the $100,000 preferred par value, or $4,000, is allocated to the preferred, and 4% of the $400,000 common par value, or $16,000, is allocated to the common stockholders. A total dividend of $10,000 would be distributed to the preferred shareholders and $40,000 to the common. In the last example, the preferred stock is cumulative and fully participating. Therefore, the preferred shareholders would receive the dividend in arrears of $12,000 first without participation by the common stock. Then the preferred and common would each receive 6% of their respective par values as illustrated previously, and the remaining $8,000 would be ratably allocated based on 1.6% of the par values of the two stocks, for a total of $19,600 for the preferred and $30,400 for the common shareholders. This slide shows a calculation of book value per share when there is a preferred stock. As shown, the stockholders' equity attributable to the common shareholders is $600,082, which, when divided by the number of common shares outstanding of 4,000, yields a book value per share of $150.02. When there are dividends in arrears for 3 years and the 5% preferred stock is both cumulative and participating up to 8%, the calculation of book value per share is more complex. The stockholders' equity is divided between the common and the preferred stock as shown. The preferred stock not only is allocated the par value, but also a portion of the retained earnings for the dividends in arrears of $45,000, the 5% current year dividend of $15,000, and the additional 3% of participation with the common shareholders of $9,000. The book value per share is then calculated with the common stockholders' equity of $531,082 in the numerator and the 4,000 shares in the denominator, for a book value per share of $132.77. These are the quiz hints for Chapter 15, Stockholders' Equity. Completion of the homework prior to the quizzes is recommended. This is the information for the problems for the chapter that will be included on the exam. And this is the end of the second part of the presentation for Chapter 15, Stockholders' Equity.